Okay, good afternoon, everyone. So this is our new chapter. This is the new chapter, and the title of this chapter is called the Introduction to Business Combination. And this chapter is quite easy to handle, very, very easy. So try to understand what we are going to learn from this chapter. Actually, we are going to learn in this chapter. These are the topics. These are the topics that we are going to learn. We are going to learn how to calculate net asset. Then we are going to compare the net asset acquisition and the stock acquisition. This is the first topic. Okay, so first we are going to learn how to calculate net asset. Then I will explain the difference between these two. Net asset acquisition and stock acquisition. So mainly we are going to learn here. So when one company acquire another company. So do you understand what is the meaning of acquire? Acquire means something like purchase. Okay, when one company purchases another company or acquire another company, how can they accomplish to purchase So first we are going to talk about this issue. So when one company acquire another company, how can they accomplish to purchase another company? Then we'll also talk about how much we should pay to buy another company or buy a company. So this is the learning objectives today's class. These are the learning objectives. So I repeat again, when one company acquired another company, how can they accomplish to purchase this kind of transactions? And second, we are going to learn how much we should pay to buy a company. Now you should know two important terminology here. You can see that one is acquiring company, referred as the parent company, and acquired company referred as the subsidiary company. So it is your responsibility to find out who is the parent company and who is the subsidiary company when you read a question. It is important to understand. So, for example, Kane University, this is something like example. Acquired So Kane University acquired Onjo Kane University. If this is an example, so here Kane University is called the parent company. Okay, Kane University acquired Onjo Kane University, so parent company is a Kane, and acquired company is called Onjo Kane University. So this is something like subsidiary company. So this is the important terminology you should learn from this chapter. So here several times I will mention you the P company. Maybe I will not mention parent company again and again. Okay, maybe I will mention you the P company. You should understand P means parent's company and S company means subsidiary company. So acquiring company referred to as parent company like Kane University, and the acquired company referred as a subsidiary company like Onjoken University. So I believe you understand who is the parent company and who is the subsidiary company, right? And what is the meaning of the term acquiring and what is the meaning of the term acquired. So this is important to understand. So when you buy another company or when you acquired another company, what is the meaning of this acquired? What is the meaning of this acquired? You can see that it means that we can buy or we can acquire net asset of a subsidiary company. Okay, this is one way to acquire. So how can Kane University acquire Onjo Kane University? To buy all net asset of Onjo Kane University. For example, you are the Kane University, you want to buy Onjo Kane. So one option is to buy all of their assets and to buy all of their liabilities. So why? Because net asset means assets minus liabilities. Okay, you buy their asset, you buy their liabilities, it means that you buy their net asset. So this is one option. This is one option to acquire another company. We have another option. We can buy the common stock. We can go to the open market and we buy subsidiary companies common stock, right? So we have these two options. We have these two options to acquire a company. Now let me explain what is the difference between the asset acquisition and the stock acquisition. They have something like a lot of differences. Look at the first differences here. So asset acquisition means a firm must acquire 100% of assets and 100% of liabilities. Do you understand? You are going to acquire or you are going to buy 100% of the assets and 100% of liabilities of another firm. Here another firm means S company. Okay, so you buy 100% asset and liability from S company. So this example is called asset acquisition. So 100% is important. It is you must buy 100%. Otherwise, it should not call the asset acquisition. You cannot buy part of their asset. You have to purchase 100% of their asset, 100% of their liability. Then you belongs to this part. Then you can say that you acquired another company through asset acquisition. Now, if you go for another option, called stock acquisition, it means that you just go to the capital market and you purchased only 50% or more. So at least 50%, okay, at least 50% of their common stock you purchased from open market, right? You know that we have the capital market, stock market. You go there, you find one interesting company to you, and you just buy 50% of their share. It means that you buy 50% of their voting rights and you can control the company. So these are the two options. Now, try to understand, whenever you go for asset acquisition and whenever you go for the stock acquisition, this is called acquired. So what is acquired? This part. We can acquire another company by purchasing asset and liability or common stock. Now, when you acquire another company, you have to give up something. You have to sacrifice something. Do you understand? You buy my company's asset. You buy my company's liability. You buy my company's common stock. So what do you have to sacrifice? What do you have to give up? Or what do you have to give it to me? You have to give me cash. Okay. So you have to pay cash to acquire another company, stock or asset. If you don't have enough cash, you can sell or you can issue you can issue the bond, right? You can issue bond to acquire another company's asset, liability or stock. Or you can issue common stock. That means you purchase my company's stock or my company's asset and you give me your company's stock. Okay. So you give me your company's stock, or you can do something combination. you can give me some cash, or with stock, you can give me some cash. With bond, you can give me some cash. With stock, something like this, or bond and stock. You can have the option to combine. Okay, you no need to pay me all cash. You can give me some of your stock also, or you can issue bond. So we can have a combination of above. We can combine 2 or 3 methods from above to buy another company's asset, liability, or stock. Do you understand? Now let's see why stock acquisition is better. Why stock acquisition is better than the asset acquisition. So based on this percentage, you can see that if you go for asset acquisition, you have to buy 100% of their net asset, right? But if you go for stock acquisition, you no need to buy 100%. You can buy only 50%, right? So which one is more costly and which one is less costly? I think this part, right? Stock acquisition is regarded as lower total cost. Why lower total cost? You can see that you can only buy 50%, and you can claim that, okay, you have the controlling power of this company. You no need to buy 100% of net asset. Just buying 50% of their common stock, you can claim your control, voting control, priority control, right? So comparing asset acquisition and stock acquisition, as stock acquisition is lower cost. Now look at the second advantage for stock acquisition. Direct formal negotiation may be avoided. What is the meaning of formal negotiation? If you want to buy my company, right? Or if you want to buy another company, their net asset, then you have to find who is the management, who is the owner, who has the controlling power. You have to do some negotiation that I want to buy your business. Okay, so you have to go through a very long process. Then you can buy another company's net asset. Very, very long process. And you have to find out who is the right man to negotiate with. But if you want to buy stock, okay, you no need to ask any people permission. You just directly go to the stock market, you have money, you buy their stock. Okay, you don't need to talk with anyone. You can easily get some stock from the stock market. Do you understand? And maintaining the accurate firm as a separate legal entity. So if you buy a stock, then more than 50% or 50%, you are the controlling owner, right? And you can do your business smoothly. The business is already there. Business already have a legal entity, right? Business already have a legal entity. You just buy it. And you buy their stock, means you get the controlling power. Now you can handle this business separately as a legal entity. So this is not a big issue. So maintaining the accurate firm, accurate means the subsidiary company as a separate legal entity. Okay, so very easy to handle this. Now the last one is the greater flexibility in filing individual and consolidated tax returns. So I remember you have already tax course. Okay, so if you study tax course second part, then you find that whenever you acquired another company through a stock, and when you prepare the tax return file, okay, they have more flexibility. There are more flexibility to prepare this kind of file, and you have some benefit. You have some more benefit if you go for the asset acquisition. So for tax return, you are going to get benefit, right? If you go for a stock acquisition, this is one point. Then if you go for a stock acquisition, this is a continuous business. It will continue as usual. You are becoming the owner only, right? So very flexible. Then you no need to negotiate with any other people. Go to the stock market, buy their share, become the controlling power, and it is lower cost. So these are the two methods that we can acquire another company. So you should know very carefully how to acquire another company, by purchasing their net asset or by purchasing their common stock. Okay, and we have to give enough. So very simple. If you buy something, you have to pay cash or any other things. Same here. Now we can see more examples regarding the definition between asset acquisition. So when we go for asset acquisition, what is the journal entry actually? And if we go for the stock acquisition, what is the journal entry? Okay, so we can see that their journal entry also quite different. So we are going to see how to handle journal entry based on these two methods. So let me put some random number. Like here again, you are going to buy all of subsidiary assets, right? So when you buy another company's asset, it becomes your asset, right? Whenever you buy another company's liability, it becomes your liability. So, and we know that asset increase debit and liabilities increase credit. The same things we are going to do here. So you buy my company's asset, it means that you buy my company's cash. So you can buy my company's cash, you can buy my company's accounts receivable. You can buy my company's inventory. You can buy my company's supplies. Sorry. You can buy my company's property, plant, and equipment. Something like you can buy my land, you can buy my building, right? You can buy my equipment, something like this. It is commonly called property, plant, and equipment. So I can put some random number like $2 million for asset. So you buy my cash, $2 million. You buy my accounts receivable, maybe $1 million. You can buy my inventories, $1 million. Supplies maybe $1 million. And this is maybe $6 million. Or $5 million. So $5 million, something like this. Then maybe you also have to buy my liability. For example, notes payable. Notes. You have to buy my notes payable. You have to buy my bonds payable also. So, for example, random number, I can put, okay, $1 million, and I can put here $2 million. Yes, so. Yes, so you buy my asset, right? And you buy my liability. So you record asset debit and you record liability credit. So we are here. We are just here. We buy assets, we buy liabilities, right? Now what you have to pay? You can give me cash, right? You can give me, if you don't have cash, you can issue note or bond, you can give it to me, something like this, or you can issue common stock, or you can combine something like this. So here we assume that it is cash, so cash credit. Cash credit, this is $7 million. So you give me this cash. This is you sacrifice. This is the money you given up. So this is the things you given up. You given up. So here we find that what is the net asset? Sorry. So to calculate the net asset, you have to calculate first total asset. total asset is $10 million. Then we have total liabilities. Total liabilities is here $3 million. $3 million. And the net asset. Net asset is $7 million. So this is very, very important calculation. So in this chapter, several times you have to calculate the net asset. Several times you have to calculate the net asset, and we buy this net asset. We buy this net asset and we pay the amount $7 million. So here we assume that there is no goodwill. Just you buy their net asset and their net ability and net liability. Without considering any goodwill. Okay? Do you understand? Calculation mistake? Three, yes, three. Yes, 3, 2, and 1, 3. So thank you very much. So here we did not consider any goodwill, right? We buy their net asset, something like this. So this is the journal entries about the asset acquisition. Okay. Then what about the stock acquisition? So what is the meaning of stock acquisition? You have cash, right? You go to the capital market and you buy 50% share or 60% share from another company. What is the meaning? Meaning is you are going to invest your money, right? This is called investment. If you buy another company's stock, it means that it is your investment, right? So investment is asset. So our journal is investment in S company. Investment in S company debit. Here S means the subsidiary company. Okay, investment in S company debit, and you pay cash credit, maybe this amount. I just write a random number, 5 million. So you go to the stock market and you buy another company's stock. It means that, okay, if you buy another company's stock, it means that you are going to invest your money. Very simple. So investment in subsidiary debit, and you pay cash credit. So this is the difference between asset acquisition and the stock acquisition. Okay, so we are going to our chapter title is Introduction to Business Combination, right? Introduction to Business Combination. So you should understand very carefully and clearly what is the meaning of asset acquisition and what is the meaning of stock acquisition. Okay, any question from stock and asset acquisition? No question? Then let me explain another important terminology. You can see that the title is Classification by Method of Acquisition. So now we are going to learn some method. Okay, some method of acquisition. So before we learn the types of acquisition, right? Types of acquisition. So here we learn types of acquisition. Now we are going to learn some method of acquisition. So we have a statutory merger, then we have a statutory consolidations and consolidated financial statement. What is this actually? So let's see the example here. So statutory merger said that one company acquires all net assets, and you already know what is the net asset, right? Of another company. So think about two companies here, A company and B company. A company and B company. For example, A company is the parent company. Okay, A company is the parent company and B company is the subsidiary company. So one company acquires all of the net asset of another company. And we assume that we have two companies here, A and B. A is the parent company and B is the subsidiary company. The acquiring company survives. Now I told you that from the very beginning, you should know what is the meaning of acquiring company. Can you remember what is the meaning of acquiring company and what is the meaning of acquired company? Acquiring means subsidiary or P? P, yes, P company. So the acquiring company, right? Acquiring company survives. Important term. Acquiring company means if this is the statutory merger, okay? If it is the statutory merger, then parent company is going to survive, right? And whereas the acquired company means subsidiary company. Subsidiary company ceases to exist. Okay, so subsidiary company is going to exit as a separate legal entity. So it means that two companies is going to merge, right? Plus sign. Company A and company B is going to merge, right? After merging, who is going to survive and who is going to cease out exit? Who is going to survive according to this definition? The parent company is going to survive, right? So what should be the name? What should be the name of this company now? So two companies going to merge. Two companies going to merge and they are working as a company. Very good. They are going to work as a company because a company is going to survive, right? A company is going to survive, so their new identity. So company A and B combining their new identity is company A because company B is ceased out, right? So this is called a statutory merger. Now, same examples I can apply here. Now, another method is called statutory consolidation or consolidate anyway. So a new corporation is formed. Try to understand. A new corporation is formed. It means that, okay, a new corporation is formed to acquire two or more company, no problem. And the acquired company then ceases to exist as a separate legal entity. Okay, so acquired company is going to cease. Okay, so the subsidiary company is going to exit, right? Subsidiary company is going to exit, no problem. And they said that stockholders of company A also, sorry, here again another point. A new company is formed. A new company is formed. So what should be the new company? So this is two combined. And they said that a new company is formed. That means that the name should not be A. Okay, it become company C company. And stockholders of company A and stockholders of company B become the stockholders of company C. So company A merged with company B, okay, with a new name, because when it is a statutory consolidation, the definition is a new corporation is formed. So you have to form a new company. Parent company and subsidiary company, they merge together and form a new name, a new company's name, a new identity. And their new identity is company C. This is the new identity is company C. However, they say that don't worry, the shareholder of A, okay, and the shareholder of B become the shareholder of C. That means this one. This part. They are going to combine together. So no need to worry about it. They said that shareholder no need to worry, although it is a new name, but we are the same. So this is called a statutory merger. consolidation. Now we have consolidated financial statement. So this is the most important part, because advanced accounting, in the advanced accounting, several times we are going to handle consolidated financial statements. Okay, so this is one of the important terminology for this course, consolidated financial statements, and we will see again and again in future whenever we explain any item from this kind of companies. We are going to use the consolidated financial statements. That means that what is consolidated financial statement? It means that financial statement of a company is going to merge with financial statement of B company, and we prepare is called consolidated financial statement. So financial statement of A company plus financial statement of B company became the consolidated financial statement. Okay, something like A company's asset $1 million, B company's asset $2 million. So it become now $3 million. Do you understand? So your asset and my asset is going to add. Your liability, my liability is going to add, something like this. So the financial statement of company A and financial statement of company B, we are going to add together, right? After that, we prepare a new financial statement called consolidated financial statement, and very, very important for our advanced accounting course. Now, we are here. This part. So how much we should pay to buy a company? So previous example was very simple. You can see this is the previous example was very simple. We buy their net asset, right? So asset minus liability, we buy their net asset. We calculate the net asset value is $7 million and we pay cash, right? This is simple example, but the real business world is not like that. In the real business world, it involves some goodwill. So why you want to buy another company? Because this company may have some goodwill, right? So goodwill is important term to buy another company. So again, this is not a simple like that. So how much we should pay to buy a company? If you want to know the answer of this company, you have to go through 6 steps. Okay. So how many steps we have? We can see step 1, step 2, 3, 4, 5, and look at the last step first. In the last step, we are going to determine the price, right? In the last part, we are going to determine the price of the company. So to get this information, we have to follow these 6 steps, right? Otherwise, it is very difficult to calculate. So let's see how to calculate this kind of steps. So step 1 is about mainly, step 1 is about determined ROA. Determine ROA. That means return on asset, right? Return on asset. So what is the meaning here? So identify a normal rate of return. Okay, identify a normal rate of return on assets of firms similar to the company being targeted. Okay, so for example, you target to buy one company, and this company belongs to manufacturing company. Now, if you go to the capital market and if you search the information, you can easily find what is the normal rate of return for the manufacturing company. Okay, so this is the information you no need to calculate. Do you understand? You can go, you can search any database, okay, for manufacturing company, what is the normal rate of return? Maybe 10% or 15%, you can easily get this information. So before calculating the purchase price, you should know who is your targeted company. Who is your target company? Targeted company maybe belongs to manufacturing firm, maybe belongs to educational institution, maybe belongs to bank and insurance, something like this, maybe belongs to service company, we don't know, any company, okay? And if you search the market, you can easily get the rate of return, okay, based on their asset. So we assume that it is 10%. And don't worry, given in the question. Whenever you will solve this question, you no need to calculate this. You no need to calculate this. This 10% is given in the question. But you should understand what is this 10%. It is just rate of return. Okay, every industry have their own rate of return. Just get this information from the market. So no question from step 1, right? Yes. Now step 2 said that apply the rate of return. So we are going to apply this rate. We are going to apply this rate to the net assets. To the net assets. So we need net asset. We know the rate. We already know the rate, right? We already know the rate from our step 1. Then we need to know net asset of target company. Okay, net asset of target company. So your target company is Oinjoken University, for example. So you have to calculate what is the net asset of Oinjoken University. Because we need to calculate normal earnings. So second step actually, step 2 actually determine or I can say that calculate normal earnings. So this is main thing about step 2. We have to calculate normal earnings. Now the question is how to calculate. How to calculate. To do so, you need fair market value of assets. You need this information of which company? Target company, not your company. Okay. So look at here. We are going to calculate target. Here we are going to calculate the normal earnings for which company? For target company, right? For target company. So how to calculate this? We need this information, fair market value of asset. We need fair market value of liabilities. Again, the question will give you this information given in the question. So this information is given. So in your question, fair market value of asset is given, fair market value of liability is given. So for example, I can give you a random number. it is something like $10 million. $7 million. So from this information, you have to calculate net assets. Okay, so you have to calculate this. And I already teach you how to calculate this, right? A minus L. So here is $3 million. So this is very, very important. Net asset. I can make it another color. So why? Because previous example, can you remember? Previous example, here, it was the simple example. We calculate net asset, right? We calculate net asset $7 million, right? And we pay it cash, right? But I told you that this is not real business example. It is not easy like that. So we already know their net asset. We already know their net asset. And if you want to pay cash, they said that no, you have to give me something more, right? Something like this. So how much money we have to pay? We have to go through this step. So we know our rate of return 10%. We know the net asset of this targeted company $3 million. Now, step 2 said that apply this rate to the net asset to calculate normal earnings. So we are going to calculate normal earnings. And the formula is net asset times ROA. Okay, net asset times ROA, right? This is the formula, and it is $300,000. So we calculate normal earnings also. Any question up to step 2? Rate of return is given in the question. And step 2, we have to calculate normal earnings. And the formula of normal earnings is net assets times return on asset. Okay, so we have to calculate the net asset first. We have to calculate. You have to calculate net asset first, then we have to calculate the normal earnings. So this 2 item is not given in the question, you have to calculate it. Now let's move on to step 3. So this is the normal earnings. Try to understand. This is the normal earnings. That means what is the meaning of normal? Normal means this is their usual earnings, regular earnings. Okay. Now we have to estimate something about future. Estimate means something about future. So we are going to estimate expected future earnings of whom? Of the target company. Okay, so we can expect how much money they can earn in the future. We can expect it. Now, in the real business world, step 3 is the most difficult part. It's the most difficult part if you work in any company or if you work in any accounting firm and your company is liable to calculate future expected earnings for another company, then you have to work very hard. It is not easy. Okay, it is not easy to calculate expected future earnings. So here in this chapter, we are going to consider this part. So now you have to remember your intermediate accounting course. In the intermediate accounting, you already learned, you must learn, because I know the syllabus, you must learn non-recurring gain or non-recurring losses. So what does they mean actually? Can you remember? What is the meaning of non-recurring gains and non-recurring loss? Can you remember this? Or if I make a little bit easy word, not the accounting word, easy word, something like unusual gains and unusual losses. Have you heard this term? Or if I make it more easy, regular loss and regular gain and irregular gain, irregular loss. Do you understand the meaning? It means that some gain, okay, may not happen again and again. Maybe will happen once in 50 years, maybe, right? Or some losses may not will happen again and again. Maybe will happen once in 10 years, something like this. It is not the regular one. Okay, it is not the regular one. So non-recurring gain or loss we have to consider when we are going to calculate the expected earnings. So if you don't know, I suggest you to go back to your intermediate accounting course and remember what is the non-recurring gains on losses or restructuring cost, something like this. It is important. Anyway, so I will explain something based on the question. Okay, I'm not going to give you the overall picture now. Maybe when I will explain some questions, then I will explain in more detail about non-recurring gain or losses. So we can estimate a number for today's class. Expected future earnings. So we assume a number first. It is, for example, $400,000. And to calculate this, I told you that it is not easy. In the real business world, especially to calculate this, we need some adjustment. So we need some adjustments. We need some adjustments to calculate expected future earnings. Now we have to remember that. So we have to calculate this, right? We have to calculate this from the question paper. And if you make mistake in this step, because I believe that, or I assume that several students will have a chance to do mistake here. If you don't have this kind of knowledge very well, non-recurring gain or loss, okay? So most of the students may have a chance to do mistake here in the exam. And if you fail to calculate future expected earnings, then step 4, step 5, and step 6 is going to be mistake. Do you understand? So be careful or pay more attention when you are going to calculate expected future earnings in the exam question. Although I will explain most of the important points that I will cover for the exam, but if you don't understand or if you don't remember, it will be a big problem for you. So for today's class, we just estimate a number. But when we will solve a question, we have to do a lot of things. Okay, not a lot of things, something adjustments to get this number. So we assume that our expected future earnings is $400,000. So what is the regular income? Regular earnings $300,000. Look at here. This is the regular. Okay. This is the regular. Regular means here you do not have any unusual activities. Do you understand? You do not have any unusual activities. Your regular is $300,000, something like this. Now we are going to calculate the expected future earnings, okay, by considering this kind of adjustments. And after considering this kind of adjustment, we find that the expected future earnings is $400,000. So it is a good news or bad news? So the regular earnings $300,000, and we do some adjustment, okay. After doing adjustment, that means we ignore one-time event. Do you understand what is the meaning of one-time event? One-time event means something will happen only one time. We have to avoid this. If we avoid this, then we can get our expected future earnings. Clear? Okay, so after avoiding one-time event, now we get expected earnings $400,000, but the regular income is $300,000. So we have a good news or bad news? Good news, right? Because if we buy this company, then we can earn more money in future. Now we know our normal earnings, we know our expected earnings. Now we are going to calculate the excess earnings. Okay, we are going to calculate the excess earnings. So step 4 said that determine or calculate excess earnings. Calculate excess earnings. So we have to calculate this. Now the question is how to calculate this. So very simple, we need this information. We need our normal earnings. We need our expected future earnings. Then when we calculate the excess earnings, we have a very easy formula. Well, so this is the formula. And we know this information. We know this information. It is something like $400,000. And this one is $100,000. So this excess earning is important. Again, if you do mistake in step 3, this is also mistake, right? This is also mistake, because in step 3 we are going to learn expected earnings. This is step 4, easy. Now step 5 is not very easy, but whenever you will read the question, you will search some keyword to solve this part, because the question may have several assumptions, like assumption 1, and we may have assumption 2. So to calculate excess earnings, okay, I mean not excess earnings, to estimate the goodwill or compute the goodwill based on excess earnings. So we already have the excess earnings and we have to estimate the goodwill. We have to estimate the goodwill based on excess earnings. Again, if your excess earning is mistake, you mean that step 5 also going to have mistake. So how to calculate this kind of goodwill? We need two assumptions. The two assumptions means you read the question paper and find out some keywords. Okay. So first keywords is something like this. I can help you. If excess earnings are expected to last indefinitely. So this is one keyword. This is the one keyword. Another assumption is something like this. If expected earnings are expected to last something like this. So we know our excess earnings, right? We know our excess earnings in both assumptions. Assumption 1 said that if the excess earnings are expected to last indefinitely, and another is called finitely or finite. So what is the meaning of these two words? That means we have $100,000 excess earnings, right? We will have this kind of excess earnings indefinitely. It means that unlimited period of time. This is the meaning. Do you understand? And if excess earnings expect to last finitely, that means limited period of time. Something like 10 years. 10 years. Do you understand? So you have to read the question very carefully to find out assumption 1 and 2 because different assumptions have different formula. Different assumptions have different formula. So in order to calculate, I repeat again, in order to calculate estimated goodwill, we are going to use excess earnings data, right? And the assumption is based on the excess earnings. This $100,000, we can use this money or we can expect to have $100,000, okay, indefinite period of time. Indefinite period of time means unlimited period of time, or we assume that maybe this kind of excess earning will last for 10 years or 3 years or 5 years, something like this. So there is a limited number, right? There is a limited number, there is unlimited number. So if it is unlimited number, then we have a formula. The formula is estimated goodwill equal excess earnings divided by the discount rate. So this is the formula. Now, don't worry about this issue because the question will give you this kind of rate given. So question will give you what is the rate, discount rate, market discount rate, okay? Here discount rate means the market rate actually. So for example, we know that our excess earnings according to our previous example, it is $100,000. And for example, question give you discount rate is 20% maybe. 20%. So 100,000 divided by 20%. 20% equal $5 million maybe. Yes. So this is the estimated goodwill. This is the estimated goodwill. So excess earnings divided by the discount rate, right? So when we will use this kind of discount rate divided by discount rate if it is unlimited. Now assumption 2 said that if the excess earnings are expected to last a limited number of period of time, maybe 10 years, then what is the formula? The formula is something like this. Excess earnings times, okay, times present value, okay? PV means present value. Present value of present value of ordinary annuity factor. So now we have to use the present value of ordinary annuity table. Okay, we have to use the annuity table to find the factor, and to find the factor we have to consider time period. What is the time period here? 10 years, right? 10 years. Okay, so 10 years. Then what is the rate? Discount rate is 20%, right? Yes, so rate is 20%. And if you remember which table we use, table 4. Table 4 is about table 4. If you use any textbook, okay, usually table 4 is about present value of ordinary annuity. So this kind of factor, okay, we need to calculate. So we need a factor. We need a factor, and we times factor. Is the times factor with the expected earnings. Okay, so something like this. So in the exam, I will give you this table. I will give you this table. So now it is your job to find out what is the factor. Okay, using table, present value of ordinary table. Anyway, the table title is present value of ordinary annuity. This is the table title. Okay, present value of ordinary annuity, PVOA. So using this table, we have to find a factor. So we can assume a factor, something like this, no problem. So it should be something like this. Maybe this is $100,000, and the factor may be 5 point, a random number. I put a random number, something like this. Okay, so this is random. This is not the actual, so I'm going to delete this. I don't have this table now, so it should like this. Anyway, I delete this. Now I told you that if you remember the previous example, it was very simple. We pay net asset, right? We buy their asset, we buy their liability, and we pay this amount net asset. Now, in the real business world, not only net asset, but also goodwill, right? But also goodwill. So you can see that we are going to determine the price. We are going to determine the price. Okay, we are going to determine the price, and this price is this one, net asset, right? Net asset plus goodwill. Okay, net asset plus goodwill. So last step, So determine the price of the company. So this is our last step, how to determine the price of the target company. So this is the question mark. The answer is we need net asset, we need estimated goodwill, and the price equal this is the formula. We need net asset, and we already know what is the amount of net asset based on step 2. Net asset is $3 million. Net asset is $3 million, and we know our expected goodwill. We know our expected goodwill $5 million. So the price of the company is $8 million. So this is the last step. $8 million is the price if you buy a company, right? So this is parent company decided to buy a subsidiary company. So before buying the subsidiary company, you have to do some working by yourself. How much money you have to pay, right? So this money may not given by the subsidiary company, okay? You are going to calculate by yourself because you are the parent company and you already target to buy another company. Now, what should be the price of this company? Collect the data, okay? Collect the data of target company, collect the data from market, go through this 6 step, and you can easily calculate this number. Okay, so this is advanced accounting. So if you target to work in any accounting firm in future, you have to calculate this kind of price, okay, for purchasing or acquiring a company. And at the time, if you remember this step, go to this step and easily calculate. Any question? So based on these steps, in another class, next class, we are going to solve the question. So I suggest you to read the question first and try to solve it, because I already explained several steps, right? I already explained several steps, so try to do it at home. But next class, I will solve 2 or 3 questions from this chapter. Okay, that's all. Thank you very much.